All right. Well, thank you so much, guys, for joining us today. Welcome to the Sage Investor webinar. My name is Jen, and I am a co-founder of the Sage Investing Group, along with Maggie and Lana. And I can't tell you how excited we are today to have our very first guest speaker. I'm going to introduce him shortly. Just a little bit of bookkeeping tip. If you guys have any questions during the course of the webinar, please type them into the chat box and we will answer them at the end of the presentation. I don't want you to forget what your question is. So if you have anything, just go ahead and type it into the chat box. So today our topic is on how to use your retirement fund to invest in multifamily. As many of you guys here know, historically, most individuals, they invest their IRAs, their 401ks, and other qualified retirement accounts in traditional vehicles such as stocks, bonds, mutual funds, and treasury notes. And I believe you guys are all here today because you know that there are actually more ways to diversify your investments to help you grow and to protect that investment nest egg. And one of the most popular ways for non-traditional asset investment is actually investing your retirement fund in real estate. So with that said, we hope that we bring you a lot of value today with our guest speaker, Josh Plave, who is an expert on this topic on how to use your retirement account to invest in multifamily syndications. He has a very interesting story on how he came about mastering the subject. So I'll let him tell his own story shortly. And just to give you guys a little background about Josh, I met him in 2019 through our Think Multifamily mentoring group. We actually learned that we grew up in the same city in Maryland, where I currently reside. And to my friends that are in this webinar who live locally here, he went to Wooten High School. Sorry, Josh, maybe too much information. But anyways, it's just so amazing to just bump into somebody out there in the world that lives so locally to you. So I'm always amazed to bump into people like that. So anyways, without further delay, I want to welcome Josh to our webinar today. Thank you, Josh, for being here.
Thank you for having me. I'm excited to be here. Let me share my screen.
Yep.
All righty. Did it just kill my? Are you seeing the presentation or is it in the PowerPoint mode?
The notes mode. Do you want to do switch? Yeah, maybe if you push the presentation. There you go.
Oh, so
Now
weird.
we see your
Okay,
presentation. Yes.
great, cool. Okay, let me just clap some things here so I can see my notes. Great. All righty. So I like to kind of start with a little, as a quick thought exercise. Where do you think the two largest sources of wealth are for the average American? The first is actually in the equity in our homes, and the second is actually in our retirement accounts. Nearly all of us have them, but few people really know how to effectively leverage their largest investable account. So let's go over how you can use your retirement account to invest in multifamily. Now, the mission I had for my company, Wall to Main, came from a conversation that I had with my dad about 3 years ago. He was kind of on the cusp of turning 60. We're starting to plan for his retirement, and we're still doing it. And he, in a few years, he plans on using his 401k to really supplement his income. And so at the time, it was doing great. He was invested in a variety of broad market mutual funds and ETFs. The market was looking generally pretty good. But my dad didn't really plan on retiring then and there. He's a lawyer, so he knows he can go for another 5-10 years and start to phase out from there. So we started talking about how to ease him out of the work and over into retirement. But the concept wasn't really clicking because he was really worried about his investments, and we were trying to time cyclically where the market would be. And so he was worried that when he needed his 401k funds the most, the market just might not be there for him, and neither would his account balance. And so nobody really wants to pull funds from their 401k when the chips are down. So I kind of presented this dilemma. And so this is really the reality for so many families across America. Just like my dad, you might be afraid that the stock market won't have your back when it comes time to retire and when you actually need your funds. So I built Wall to Main that, to aim to help investors use multifamily to de-risk their portfolio and build a better future for themselves. Now, if you're watching the video, you might be wondering why a 30-year-old guy is up here talking about retirement accounts. I actually started when I was 16 years old. I'd earned a bit of money that summer as a camp counselor. Jen, I was actually working at Landon as a camp counselor. And I decided, because my mother and my grandfather both were CPAs, and they suggested that I was going to, suggested that I start investing for the future and really look out for myself. So I opened up a Roth IRA at the time, and started investing in equities from there. Jumping ahead about 10 years, though, my mother and my grandfather, who I mentioned already, they both unfortunately passed away. And what it did was it left my sisters and me with the retirement accounts of a baby boomer and a member of the greatest generation. It wasn't really a life-changing amount of money, but it was enough that I knew I needed to be a good steward of their legacy and preserve everything that they had worked for, and make sure I was, growing it into the future in a methodical and strategic way. So what resulted from that was a lot of learning on the retirement account space. And I learned that this entire space is generally, on the education half, fairly biased. Almost all of the education is done by custodians who provide really good education, but a limited amount, so that they can drum up enough interest in business to get you interested in buying their products, but really not giving the full picture from, to understand what you can do beyond just their services. So I'm here to give you that full picture from a fellow investor's perspective. So let's start with some basics. Now, this is your chance to diversify. You probably have already figured this out, but your IRA, your 401k, any of your plans are not limited to just stocks and bonds. You can invest in virtually anything that you think is a good investment. It's fair game. There's 3 limitations, as you see here: collectibles, art, jewelry, cars, alcohol, things of that nature. Life insurance policies you can't buy, and S corporations as well, or shares in S corporations. The only hitch is that, at custodians like the ones you see here on the screen, they only facilitate stock and bond investments. So you need to move the funds over to a custodian that allows for alternate assets, you could say. And with control, what I mean here is that it needs to be in your possession, away from a current employer, you could say. So what I'm saying here is a current plan would need to allow for what's called an in-service rollover. Most plans don't allow for an in-service rollover. It's worth checking if this is your situation, but typically we're talking about previous 401ks from past employers, or other IRAs or other types of accounts that maybe you have established outside of a current employer or someone you're no longer employed with. All right, so now before we start kind of wheeling and dealing with our accounts, we need to learn a few rules. The first is there's no current benefiting. So you today cannot benefit from your retirement account for the dollars that are meant for future you. And then your retirement account can't benefit from your actions today, which leads us directly into participation. You cannot actively participate in the investments that your retirement account is making. So this means that you can buy a house with a retirement account. You can certainly do that, and you can manage it hands off and allow other people to work on it. But you can't go in and swing a hammer or sweep a broom. That's considered sweat equity. Anything like that, you're actively contributing to the benefit and success of your retirement account, which is not allowed. When it comes to multifamily, you can't use your retirement account to invest in a deal that you're a general partner on. So when I syndicate deals, I can't use my own retirement money. So my retirement money is always sitting at, a different syndicator's offering. And then when it comes to income, you might have kind of picked up on it, but none of your income can be active. Anytime that you're actively earning income on a deal, you cannot use your retirement account. All income in a retirement account needs to come from passive activities like rental income. Capital gains are very common. Interest income is fine too. But because of all of this, I like to use the phrase, think of your retirement account like it's another person. This is an important one. Keep it in mind, and we'll come back to it in a bit. So now let's talk about the people that you can and can't invest with. The concept here is called disqualified persons or people. This is someone you can't do any of the following with. When it comes to interaction, you can't have any business from your retirement account to them or their retirement account and you. When it comes to what you can buy, you cannot buy let's say you buy a rental property with your retirement account. You can't let a disqualified person live there for free or rent at all, because they could do one of two things. The theory here is that you could give them a favorable rent, and you could rent it to them for $1 a month, and then they could benefit from the power of your retirement account. Or if it's maybe your parents or grandparents and they wanted to avoid the gift tax, they could funnel $10,000 a month in really nice rent to your retirement account and really balloon your retirement account. So they're trying to avoid those types of interactions. And then same with a sale. You could provide a very favorable sale one way or the other. And so disqualified people can't buy your property that you're investing in with your retirement account. When it comes to co-investing, very similar. You can't invest your retirement account just like you can't put it in your own deal. You can't put it in a deal that they're investing in, or that they're managing, sorry. And then when it comes to actually investing together, you can't invest with a disqualified person. The one caveat to this, though, is in multifamily, it typically is okay, actually, because we're offering a security and you're buying shares in a security. It's very similar to, if me and one of my disqualified people wanted to buy shares in Apple and I wanted to use my retirement account and they wanted to use some cash, that's perfectly fine. There's no issues there. It's exactly the same with the syndication. As long as it's shares in a security, it's fine if you're working with disqualified people in that situation. So that's okay. Now, who are your disqualified people? This is the family tree. We're talking linear ascendants and descendants, parents, grandparents, children, spouses at any level. These are the ones, anyone in dark blue, that you can't rent from, or so you can't invest with. Anyone in white is allowed. So you can invest with your siblings, aunts, uncles, cousins, in-laws. That's all fine. Obviously there are a lot of people on this list that many of us would consider investing with at some point in our investing careers. So it seems pretty restrictive, right? So how can we get around this? Well, there's actually, if you recall from a few slides ago, you need to think of your retirement account like it's another person. Well, that same thing goes for your disqualified people. Their retirement accounts are different people, and their retirement accounts aren't disqualified people to you. So this means if everyone involved is using only their retirement accounts, you can turn your family tree from this into this, and everybody can get investing together and pool all their funds together. That's actually what I do with my family. We built a holding company and we pool all of our retirement funds together to get into more deals at once. So for example, let's say we have an investment minimum of $75,000. If there's 3 of you, obviously you can get in each for $25,000, which would allow you to be invested in more deals, further diversifying your retirement account. So if you like that little trick, I've got a few more for you. Feel free to text the phrase top 10 to the number 66866, and I'll be happy to send over to you the top 10 tips and tricks when investing in multifamily. All right, so let's jump into what accounts are available to you. So there's really 2 types of accounts. As an investor and not a custodian, here's kind of what's been my experience with these 2. Custodians by law are not fiduciaries, so they're not required to look out for your best financial interests, and they won't, honestly. In other words, they tend to look out for themselves. They'll hit you with fees, and the fees themselves will grow as your investments bring in more and more returns. The better you do as an investor, the more you have to pay with a custodian, likely. So not only are they expensive, but they're pretty slow. Some of them are notoriously slow, and approval for a deal, which is really just a compliance matter for them to have some paperwork so that they can show it to the IRS if there's ever an audit or something, that can take weeks. And we've seen that prevent investors from investing with us. We've actually had some investors miss out on wiring their funds in time because the paperwork is just being held up at the custodian, and it's not because it's a complication with paperwork. They just don't have enough people dedicated to processing that paperwork. So they can really interrupt your desires to, of how you wanted to invest with your retirement account. So instead, I like to advocate for checkbook control. It's lesser known, but extremely powerful. It's something that I use. All my investing friends use it as well. It's really what I believe enables you to make the most of your retirement account. So let's check that out just a bit more. So with checkbook accounts, you have two options, just to keep things very, very high level. Anybody, including non-US citizens, can open a self-directed IRA, but it does obviously, as you can see here, have a lower contribution limit. With the solo 401k, this requires self-employment income though. Just to kind of cover the basic ground rules for it. Generally speaking, you cannot have employees in the associated business that's sponsoring that 401k plan. Spouses are totally fine, but anyone that's working 500 hours or more is generally going to disqualify you from establishing this type of an account. So just to kind of briefly pause here and mention something about eligibility. Let's say you have a business and you're earning self-employment income in it, but you have a few individuals who obviously would disqualify you from opening up this type of account. If you have a side business, let's say you've got a consulting or an expert witness business, and that one is just you yourself, there's no other employees with it. Could you open up a solo 401k for that business? Well, the answer is actually no, unfortunately. In almost all cases, if you have one business that has employees and that you can't sponsor a solo 401k over there, and then you have another business where you could theoretically, it would be considered, sheltering that plan away from the employees in the other one, which is considered discrimination. So you wouldn't be able to sponsor it, unfortunately. But on the positive side, this account does allow for much greater annual contribution if you're eligible for it. Benefits from incurring absolutely no taxes when investing in multifamily, which unfortunately the self-directed IRA doesn't. So, we're going to get to that in a minute. But first, I just kind of want to go over what these accounts generally look like structurally. So the first step is going to be that diagonal line. You open up a new self-directed IRA at a self-directed IRA custodian. You're going to roll over old funds from an IRA, 401k, 403b, TSP, any of those types of accounts. And at the same time, your vendor is going to open up and establish an LLC for your IRA, which will be owned in whole by the IRA account. From there, that LLC you can manage and run just as you would any other LLC. It has a bank account just like another business, and from there you can wire out the funds and you can invest in anything you'd like. And the expenses and income strictly have to flow directly into that LLC, not to you or to the custodian account, just back into the LLC. And then from there, that you can do what you want with it. With the solo 401k, there's a bit more going on the screen, but it's actually even simpler. You just have the solo 401k. You contribute to it and you invest from it. No other vehicle. So you can fund it through contributions from the business that is sponsoring it, as well as rolling over funds from old accounts. And then from there, you just invest directly there. Again, expenses and income flow directly into that. You control the investments. And with the solo 401k, just like a normal 401k at an employer, you can take distributions and you can execute 401k loans as well. So how do those rollovers work? How do you actually fund the accounts in the first place? Well, here's how it kind of works out. If you have a Roth or an inherited IRA, those types of accounts are unfortunately locked and they can only be moved into a self-directed IRA. They're not allowed to go anywhere else. But when it comes to a traditional IRA, 401k of either Roth or traditional types, a 403b, a thrift savings plan, TSP, any of these other types of accounts, they're totally free to move and they can be directed into a self-directed IRA if that's all you're eligible for. Or if you can sponsor a solo 401k, you can put those funds over into that type of account as well. So why would you want to go all the trouble of establishing a solo 401k? Well, if you recall, I mentioned previously that this type of account avoids taxes, which unfortunately come into play when investing in multifamily with your retirement account. So the concepts here are UDFI and UBIT. So I'll explain what those are. Let's say we're buying this apartment building. The top, section in light blue, that's our equity. We put a down payment of 25% on this property. And in dark blue, with 75% leverage, we bought it with, funds from an outside source like a lender or a bank. So when you use a self-directed IRA, the portion of income that comes from the equity that you put up, that's never taxed. You don't have to worry about that at all. It's still tax-free. When it comes to the portion that where outside funds, non-tax deferred funds were used, that earns what's called unrelated debt financed income, or UDFI. So you earn UDFI, and then ultimately you have to pay what's called unrelated business income tax, or UBIT. So the nice thing is, though, because you're earning, taxable income on this portion, you can actually use the taxable portion's share of depreciation, operating expenses, interest expenses, really any type of loss at whatever that prorated share is. So for the first year, when you have 75% leverage, you can use about 75% of those losses. So the real question when it comes down to it is, how bad is UBIT? A lot of people like to make this out to be some big bad boogeyman. There are people in the custodian industry that really instill a lot of fear, and they kind of drum up a lot of business and direct people to their products based on scaring them in UBIT. And so when I started investing, before I even started my company, I wanted to understand concretely how bad UBIT might be and how much I need to look out for it. So I didn't want just a vague understanding of it. So I ended up building what I have found to be the industry's first UBIT calculator. So I'm able to take expected performance and figure out for my investors what the anticipated returns will be post-tax once they have to pay UBIT. So I can go out and look for the right investments for my investors. So let's take a look at one of those properties that we purchased. So this is something that we closed on about 2 years ago. I apologize, it's not a very good looking spreadsheet, but there's a lot of numbers here, so you should focus on lines 3 and 5. Member cash flow, that's going to be your pre-tax returns that you see from the property. And line 5 would be UDFI taxes, otherwise known as UBIT. And so what we can see here, and what we see in most deals, is that for the first 3 to 4 years, you're going to see low to no UBIT taxes, somewhere between $0, maybe a couple $100, something that's pretty minimal. And so you wouldn't have to really worry about the impact there. What we're really going to see is, if you take a look at year 5, when there's a sale, when there's a capital event, that's when you're going to see the larger UBIT impact. So on a $100,000 investment here, we're seeing almost $30,000 in taxes that are incurred. And so that's a pretty big amount. But what I wanted to do was kind of take a look at it annualized over the life of an entire, investment. And so if you take a look at the bottom right, that extra tab that's hanging off that says UBIT reduction, that's going to give you the annualized reduction for UBIT on an annualized basis, a cash on cash basis, as well as an IRR basis. So what we've seen is that most deals typically will have an impact of between 4 and 6% annualized. So on this deal, we were seeing just about 23% annualized returns, and with a 6% reduction, that still leaves us with a 17% return annually for our IRA. If you take a look at the bottom, though, you'll notice that the IRR is even less impacted. It's only a 4% reduction. And the reason for this is, if you look above, there's a refinance in year 3. We're actually returning about 61% of our investors' capital on this deal in year 3. And because of that, we're able to get more of our investors' original funds back into their hands. And a return of capital is not a capital event. So you can actually take that money, reinvest it into another investment, another deal, without ever incurring a UBIT penalty that will eventually happen 2 years from then. So that's typically the type of investment we like to look for our investors, but it's just something to be aware of. And so obviously all of this isn't really optimal, I would say. So the question is, how can you get around UBIT? So there is one small trick that can have a big impact and save you, on that deal, it would have saved you about $30,000 in taxes. So let's say you have a self-directed IRA that's funded with traditional non-Roth money, but you don't have any self-employment income currently, so you can't, you're not eligible for a tax-free option. So you could invest with your self-directed IRA now. You can get started on whatever deal you find fits your criteria. And at some point down the line, before a capital event occurs that would trigger UBIT, you can earn self-employment income. And let's say you could do some consulting work on the side, any kind of business that would be a consistent business where you could establish and open a solo 401k. So once you open that solo 401k, you can then initiate an in-kind transfer. In-kind transfers aren't too difficult. You'll still be invested. It'll just move from the self-directed IRA over to a solo 401k. You'll just change the ownership on it. And once you do that, as long as you do it prior to the capital event, you're going to avoid UBIT. And so it's the UBIT penalty is dependent on where it's sitting at the time of the capital event. And so as long as it's sitting in that solo 401k at the time, you're perfectly fine. Now, you need to keep in mind, you do need to have self-employment income for every year that you are, sponsoring and establishing a solo 401k, or else you would need to close the account down within 12 months and transfer it back into a self-directed IRA. So just something to kind of keep in mind there. But if you want to try to avoid UBIT, if you don't like paying taxes too much, then there's your key to avoiding UBIT. So just a quick reminder again, that's one of the little tips and tricks in my free PDF. So feel free to text the phrase top 10 to 66866, and I'd be happy to send it your way. But other than that, that's about all I have for you guys this afternoon. I'd be happy to answer any questions.
Thank you so much, Josh. That was so informative. I learned so much every time I listen to you. So yeah, I have some questions, and if we also have a question, so I will give our guests their turn first to ask. Sarah Bassett said, if you have an LLC with rental income, is that considered self-employment?
Unfortunately not. Any kind of passive income isn't considered self-employment income. So it would have to be something that you earn yourself actively.
Okay. That's a great question. Do you ladies have any other questions? Maggie, Lana?
Yeah, Josh. So one of my family members asked this one. She's a teacher and she has a 401c, I think, C3. Does that also work as a traditional 401k where you can transfer it to a self-directed? Or
yeah, I'm guessing it's a 403b because that's a government account. And yes, so 403b it's a QRP, it's a qualified retirement plan, and so it operates just the same as a 401k.
Got it.
Josh, so earlier you were saying for the self-employment, in order to open the solo 401k, it can be, so it has, I guess the entity it's either you by yourself or you with your spouse. So I just want to clarify, if you hire your children as employees under this entity, like would that still count, do you know, or no children either?
I haven't dug into that too much.
Okay.
My guess is that it would if they worked over 500 hours. I think the only carve out is for spouses. So I don't think it allows for other family members, but the rule really is someone who's working 500 hours or more in 3 consecutive years. So if you wanted to allocate them 500 hours in 2 years, or you wanted to keep them at 400 hours across multiple years, you could still sponsor a solo 401k. It's just managing the hour mark. That just changed recently from 1,000 down to 500.
Okay. That's manageable. I don't want to overwork my kids, so I think 400 hours is probably a good idea. Okay, that's good to know. And then earlier you were saying how when you roll over funds from your old IRA or 401k account, you have limitations, right? I forget, the limitation was like $6,000, I think, for a self-directed IRA account, and the contribution limit for the self-directed IRA for the solo 401k is like 67,000.
It's 56, I think.
56,000. Okay.
56 or 57. Yeah.
Okay. So I just wanted to make sure. So that contribution limit, does it apply to when you roll over the funds? No. It's
not at all. No. Yeah.
That's like checking account or something.
That's the nice thing. So this is what's called a backdoor IRA. So let's say you have a 401k that has $200,000 in it. You can roll over 200,000 into your IRA and immediately have that to use. The backdoor, this also applies to like a backdoor Roth. So there are income limits for a Roth account. You can't earn more than, I think it's $150,000 or so and still contribute to a Roth IRA. What you can do is, if you're a high income earner, you can contribute to let's say, a Roth 401k. You can put in a ton there because there's no income limit for that. And then once you move it over from a 401k to an IRA, you can bring the full amount down, and you don't have to worry into a Roth IRA, and you don't have to worry about those income limits.
Okay, that's great. And I get asked this question from time to time from investors. I think like when you create the self-directed IRA account with a solo 401k account, you can elect whether you want it to be traditional or Roth, correct? You can
Yes.
make that election at that time. And so I know traditional means that, you invest it pre-tax dollars, so then you get taxed later when you take out that money during retirement. And Roth is, using, I guess, post-tax money. So you don't have to pay taxes when
Exactly.
you
Yeah.
benefit. So I don't know, have you thought of like, I don't know if you get asked this question too, but do you recommend Roth or traditional?
It depends on everyone's individual situation. I love the Roth. I think it's a great strategy,
Mhm.
especially if you are banking on yourself. If you're someone who's 70 years old and you don't have much time to kind of recoup paying the taxes now and the potential growth going forward, wouldn't suggest it. But for someone who's young and thinks that they're going to be earning when they retire, be in a higher tax bracket, I think it's a great opportunity. And as it stands right now, we're currently in all-time low tax brackets. So if you do choose to pay, the income for contributing to a Roth IRA, you're doing so at the all-time lowest possible moment, and so from there it grows tax-free. Obviously, you might incur some UBIT along the way if you invest in multifamily, but yeah, typically you're gonna in 30, 40 years, you're going to be facing something of a higher tax bracket, I would imagine.
Mm-hmm. Okay, thank you for that insight.
Yeah.
Hey Josh, I was just curious, because since you take care of all your family retirement account, and you invest in multifamily and alternative assets, have you ever like tracked on how does the market's doing versus what you're doing on what taking off?
Yeah, so I haven't tracked, well, actually I did track when I pulled funds from the stock market over to multifamily, and I did so, let's see, I did it in September of 2019, and have moved into multifamily, and let's just say it didn't work out the best because we had the craziest possible year. Obviously there was so much stimulus injected that the stock market wildly inflated, and it saw 20-30% returns. So I probably missed out on some returns, but I was invested in multifamily, where it's an interesting situation because the multifamily needed to ride out and kind of make sure that we were sustaining the storm. And so nothing terrible was happening on property, but for the deals I was invested in, they were keeping the funds on keeping the funds on site as reserves to make sure that they could pay out the principal and interest. And so I haven't actually seen any distributions from those investments still, but we know now there's so much stimulus going on that the valuation of those multifamily investments are most likely inflating alongside stocks as well. It's just you're not seeing that day-to-day ticker that changes, but you'll see it when the eventual returns come in. So we'll see what the tail of the tape will be when everything's said and done. But overall, when I first did this, I actually looked back at how things were from 1990 to 2020, just multifamily versus the S&P 500. And I found that multifamily is 58% less volatile while still providing greater returns than the S&P 500. So it's just, you're not going to see those wild fluctuations like we saw last year with 20-30% returns, but you're going to see consistent 9-10% returns year in and year out that just kind of continue to grow and accelerate your account balance. And it's going to always be there for you in a stable environment.
I have one question for Josh. Hey, Josh, I don't have a 401k because my company did not offer me any matching. So somehow, like, in my younger age of career, I did not opt into 401k. So what is the advice you would suggest? And we recently, like 2 years back, we started into flipping business actively. So we are still in the active side of the business, not the passive. So what would you suggest? Because these 401k, IRA, those things are still newer to me.
Yeah, if you're actively involved, would highly suggest sponsoring a solo 401k if you can. It's a unique opportunity. I consider it to sort of be the holy grail of retirement accounts, of investment opportunities, especially the Roth one, because you can grow it, you'll grow it tax-free because it's, eligible for tax-free growth. And then if it's Roth, you'll never pay taxes on it on distribution. So if you have the opportunity to funnel some money into a 401k plan that you can sponsor, that's a great opportunity. But yeah, a lot of people find themselves in that situation where their W-2 employer doesn't provide a match. And so maybe there's not necessarily a purpose of sponsoring or of contributing to that 401k because there might be limited investment options, but you can still, on the side, you can contribute to an IRA as well. You're not limited to one or the other. When it comes to 401ks across the board, I should mention, so let's say you got a 401k at your employer and a solo 401k that you yourself have sponsored. There's still that 56, 57, whatever it was, contribution limit for the year. And so if you're doing 20 in one, you can't do 60 in another. Or another full 56, we'll say. So it's that full, bucket that you have to fill between different types of 401ks, but they're all within the same category. So that $57,000 amount, it's limited to the 401ks overall.
And second question is that the LLC we have, it's a single member LLC right now, classified as corp for taxation purpose. So can I be considered like a self-employment also, or it is just single member LLC? Or can you mix match?
Yeah, it would be considered self-employment. I mean, if you're earning, are you reporting 1099 income on it?
Not yet, no.
Okay, that's typically the trigger. If you're paying 1099 and you have to then report, yeah, hey, I'm paying, what is it? Medicare, Medicaid, Social Security. If you're paying those portions as the, employer, you can, because you're the contractor or the employer for that situation. If you're able to do that, that's typically when you can then sponsor the solo 401k.
Okay. Okay. Thank you.
Yeah.
So I have one more question. So for anyone interested in, sorry, I think Lana has a question too. Do you want to go first, Lana?
I do. Do you mind? Okay. So you actually had a slide about maybe when you have a W-2 and you have your traditional 401k, you can actually roll that into your own solo 401k if you decide to, like, say, leave your W-2 job. And then you also mentioned that, if you can, in the future, to avoid kind of like the tax impact, if you have, say, a self-directed IRA and before the capital event occurs, transition that into a solo 401k. So if you have so I guess my question is, if you have a traditional 401k that you roll over into, traditional 401k, you roll over into a solo 401k, and then separately you have a self-directed IRA. Can you roll that self-directed IRA funds into your solo 401k?
Yeah, as long as it's traditional money and not Roth, you're totally able to do that.
Okay.
All right, so my question was, if somebody wants to open their self-directed IRA account or solo 401k account, like, is there a custodian that you recommend recommend they working with to do this?
Yeah, I typically recommend two different companies depending on the type of investor that I'm talking to. If you plan on kind of being more actively involved and you want to dabble in a few different types of asset classes and different types of transactions with different partners, maybe I suggest a company called Safeguard Advisors. They will establish the custodian account and the LLC for you, and in perpetuity you have an advisor that you can talk to and ask about, hey, is this a prohibited transaction? Can I not do this? Can I do this? Because every situation is different, and so you're looking to kind of come up with creative solutions. And so that's a little more expensive. It's about $1,100 to establish, but it's only $130 annually to continue to sponsor that plan. And then you always have those advisory services. If you are just, if you plan on, let's say, becoming an LP and using these funds to invest in syndication, that's, you kind of have your bread and butter investment. I typically would suggest using a company called Rocket Dollar. They're $360 if you use the code wall to main. That's $50 off right there. $310 to open up an account, and it's all online. It's totally streamlined, and it's only $15 a month ongoing. So it works out to $180 a year. So overall, very low cost, and then the costs and fees don't grow with your account balance.
Cool. Thank you. So anyone else have any other questions?
Sorry, I have one more question. You actually had a slide on how the UBIT does take a deduction on the typical returns. With that in mind, are there returns that you look to try to see for your UBIT, for your investors, accounting for the UBIT deduction?
You mean like a certain target that we're trying to reach?
Yeah.
Yeah. It typically starts somewhere around, I'd say 14%. Anything below that is, if I'm really smart, I'm actively involved in maybe some, growth type stocks that I'm keeping an eye on, I can maybe achieve something up to about that amount. So I'm really looking for something that, everything's obviously conservatively underwritten. So if you're hitting 14% on a conservative basis, you might see even better going forward. But yeah, I mean, I typically want one of two things, either a very small UBIT impact. So I know if we exceed returns, it's still going to have that small impact going forward. And so if we do even better, it'll grow kind of in lock with the improving returns, or just, this happens to be the greatest deal in the world and we're smashing it out of the park. And even if there's a big UBIT hit, I don't care. So one or two of those situations. Yeah.
Thank you. All right. Anybody else in our participants panel who want to ask any questions? All right. Well, if not, that's fine. We can send Josh's contact information in the, unless, do you have something to share, Josh, or do you want us to share that during the, when we send it out, the webinar recording?
Yeah, you can feel free to send it out. That's fine.
Okay, well, yeah, we'll share his contact information if you guys have any additional questions after the webinar, but we'll send you the recording shortly today. And, oh, thank you. Sarah said, very informative. Thank you very much.
Thanks, Sarah.
All right, well, thank you so much, everyone, for attending today. It's great seeing you, and then we hope to see you again in 2 weeks for our next webinar. Topic to be announced. Thank you. Bye-bye. Thank you so much, Josh.
Thank you, Josh.
Thank you.